A money tsunami is predicted to engulf the market before the year ends. Our favorite Fed Chair Jerome Powell says that the economy is no longer overheated, thus fueling speculations of a September rate cut coming. If you're confused about how this affects your bags, then stay until the end of the video and find out how to take advantage of this opportunity. Now, aside from Powell's comment, the latest U.S. Consumer Price Index, or CPI, data shows that inflation is actually cooling down. This popular measure of inflation fell 0.1% from May, putting the 12-month rate at 3%, its lowest level in more than 3 years, a significant drop from the 9% in early 2023, and of course, close to the Fed's target of 2%. Now, this strengthens the possibility of a rate cut coming in September. Traders are now pricing about a 90% chance of a September rate cut, up from an earlier prediction of 70% just a few weeks ago. Citibank Research also is predicting 8 rate cuts in a row starting in September. Whoa! First things first, let's review why everybody is so obsessed with these interest rates anyway. Why whenever there is news of rates being chopped down, the markets go up, and whenever there's news of higher rates or higher rates for longer, the market can be a bit skittish. When interest rates get cut, borrowing money becomes cheaper. This encourages businesses and consumers to take out loans and spend more. Often rates are cut in a recession to do exactly that, which leads people to an incorrect correlation. More spending means more business activity, which can boost company profits and in turn push stock prices up even further. The increased money supply also means more money to invest, thus investment instruments also go up. As people see that everything's going up, bullish sentiment permeates the markets, which could further add fuel to the buying frenzy. On the flip side, when interest rates go up, borrowing costs also go up. Okay, this can slow down spending and business investments, leading to lower profits, potentially causing stock prices to drop, causing a recession. With things dropping, more pessimism, more fear in the market. People hold back spending, people hold back investing, everything falls on its face, and you know the rest of the story. Now, you might be thinking, why don't they just keep the interest rates low all the time? We can all just be happy, right? Well, more on that in a second. But I wanted to let you know real quick about the Wealth Mastery newsletter, your weekly guide to the cryptocurrency markets. Our readers love it. I'm sure you will as well. And here's why, because every week my team of researchers and I, we are helping you to not just stay ahead of the curve, but we're also helping you to save your time by finding you the latest and the greatest insights on altcoins, meme coins, DeFi, airdrops, charts, and much, much more. Join our 135,000 plus weekly readers for free. Check it out. Link in the description or the pinned comment over on X. Right, back to it. So it is not just as simple as keeping the rates low. We have to remember that lower rates also encourage spending. People will start thinking they can maybe afford to buy a new car, maybe the newest smart TV model. With increases in spending, inflation will also go up, which means lesser purchasing power for the dollar. This is the reason why the Fed is trying to find a sweet spot wherein the rate is enough to encourage growth while trying to make the inflation rate palatable to consumers and, of course, for the Fed. The inflation rate, again, as mentioned, is targeted to be around 2%. Now let's look at some historical data on how interest rates can affect the market. This chart from Carson Investment Research shows how the S&P 500 reacted to rate cuts previously. In the long term, returns after the implementation of rate cuts are positive for the market. Since 1984, the S&P 500 registered a 4.4% average return for the first 6 months after a rate cut and 8% after 12 months. But data also suggests that not all rate cuts are the same, and it's not always a party. You see, during a recession, the average return for the next 12 months after the rate cut is around negative 11.6%. Remember, if we get rate cuts during a recession, it's kind of a last-ditch move to try to spark things and start the economy back up. Now, here's the rub. You might want to sit down, okay? A recession in the U.S. usually comes 18 months after the Fed's last rate hike. The last one was in July of 2023. That means if that pattern holds, we are due for a recession in the next 6 months. Now, some are arguing that we're already there. Okay, wait, Lark, does that not make sense? Inflation's going down. The majority expects cuts to flood the market with money. Why would this happen? Well, the simple explanation would be this. It takes time for the full effects of higher interest rates to ripple through the economy. The Fed basically attacked the economy with a sledgehammer. It's a pretty blunt instrument. Remember, higher borrowing costs will gradually slow down consumer spending and investing. The effect does not happen right away. It takes time. Ellen Zentner, Morgan Stanley's chief U.S. economist, says that a hard landing recession is certain to come for the economy, and high rates are to blame, even though markets are starting to position for Federal Reserve loosening its monetary policy later this year. But is it all set in stone? Well, it depends on who you ask. If we are to believe the Fed, the US central bank does not see a recession and they think they're going to pull off the soft landing, at least not a recession in the near future. They'll always come. They always do. Even some analysts like Goldman Sachs chief economist Jan Hatzius shares the Fed's optimism. Just maybe we have enough economic tailwind to break the 18-month pattern. Remember, just because the pattern doesn't mean it's set in stone. Also, if we look at other countries, it seems to be a lot to be optimistic about out there. Japan has just avoided a technical recession. The latest figures from the UK show that it swiftly moved out of one. So how does this affect us, and should we do anything? Well, you first need to understand that when rate cuts happen in a non-recessionary environment, it is bullish, okay? And I bet most of you watching are interested in investing and probably have a big chunk of your money in the crypto space, right? Obviously not financial advice, but I'll tell you what I'll do. I'll do nothing. Years of investing have taught me that everything is a cycle and not to second guess what the Fed is going to do. So instead of worrying, just make a plan. If the Fed floods the market with more money, then hooray. We filled our bags during the more tumultuous phase of the market previously, right? We're ready for this. Are you ready? Maybe you're not. Maybe you're panicking. I can get that. Look, it's foolish not to take profits when the opportunity presents itself later. Sooner or later, the market will go down. It could be just a simple bear market, full-blown recession, the new Great Depression, who knows? It could be this year, it could be after a few years. And based on experience, what's best is to accumulate and ride the gosh darn markets, wash, rinse, repeat as many times as you possibly can. Look, if we get the rate cuts and there's no recession, that provides serious economic tailwinds for risk assets, especially cryptocurrencies, for maybe 12 months, maybe 18 months, maybe only 6 months. There's a lot of good theories on how soon the markets could top out, but make no mistake, they will top out. The only question is how long after the rate cuts start will we see a topping situation happen? Watch for those top signals. Go watch my top signals video in case you haven't seen it yet. It's very informative. I hope it's informative for you. And just be aware. The accumulation time was previously, if you're late to the game, still some great deals out there, but the selling time will come. And that bullish tailwind from rate cuts and global liquidity increasing, all that stuff, it's going to move us nicely into 2025, in my opinion. Thanks for watching.